Ever wondered how Warren Buffett, the legendary investor, amassed his fortune? Today, we're going to take a closer look at the man himself. Born in Omaha, Nebraska, Buffett's journey from a humble paperboy to becoming one of the richest people in the world is nothing short of inspiring. His keen interest in investing blossomed at a tender age, and by the time he was in high school, he was already running small businesses. But the magic truly began when he adopted the principles of value investing. This approach, in essence, involves buying stocks at less than their intrinsic value. It's about hunting for bargains and then having the patience to wait for the market to recognize their true worth. Dubbed the Oracle of Omaha, Buffett's approach to investing is centered around the concept of value. Stay tuned as we delve deeper into his philosophy and strategies in the upcoming scenes. So what exactly is value investing? This investment strategy, championed by Warren Buffett, is the practice of buying stocks that are undervalued compared to their intrinsic value. Essentially, it's like finding a diamond in the rough, a high-quality asset that the market hasn't fully recognized yet. Intrinsic value is a company's fundamental, true worth, calculated by looking at factors such as its assets, earnings, dividends, and cash flow. It's like peering beneath the surface to see the company's potential, rather than getting swayed by momentary market trends or stock prices. Buffett's philosophy is simple yet profound. Price is what you pay, value is what you get. This means that the price you pay for a stock does not necessarily reflect the value you receive. You could pay a high price for a stock, but the company might be overvalued and not worth that price. Conversely, a low-priced stock might be a hidden gem with an intrinsic value far exceeding its current price. This brings us to the concept of margin of safety. This is another cornerstone of Buffett's approach to value investing. It's the difference between a company's intrinsic value and its market price. The larger the margin of safety, the greater the potential for profit, and the lower the risk of loss. It's like a built-in buffer, protecting you from overpaying for a stock. So how do you identify such opportunities? Well, that requires comprehensive analysis and understanding of a company's financial health, industry position, and future growth prospects. It's not just about crunching numbers, but also about understanding the business model, the management team, and the competitive landscape. Buffett's focus is always on the intrinsic value of a company, rather than short-term fluctuations in its stock price. He does not get swayed by market trends or hot tips. Instead, he makes informed decisions based on thorough research and analysis. In a nutshell, value investing is about buying quality assets at a discount with a focus on long-term gains. It's about being patient, disciplined, and investing in businesses that you understand and believe in. It's about being a smart, savvy, and strategic investor, just like Warren Buffett. But how does one determine the intrinsic value of a company? A pivotal question indeed. The answer lies in doing your homework. It's about peeling back the layers to understand the financial health and long-term prospects of a company. Think of it like a detective piecing together a puzzle. You're scrutinizing balance sheets, income statements, cash flow statements, and other key financial indicators. You're digging into the company's business model, its competitive position, the industry dynamics, and the company's management team. You're also assessing the company's future potential in terms of growth opportunities and market trends. This is not a process to be rushed. It requires time, patience, and a fair amount of financial savvy. But it's a critical step in making informed investment decisions. Remember, Warren Buffett famously spends 80% of his day reading and thinking. It's this relentless pursuit of knowledge that's made him one of the world's most successful investors. To invest like Buffett, you have to be prepared to roll up your sleeves and do some serious homework. Now that we have a company worth investing in, do we go all in? That's a question that might be tempting to answer with a resounding yes. But Warren Buffett would likely shake his head. Why? Because his strategy emphasizes the importance of diversification. Diversification is the practice of spreading your investments among different types of assets and industries. Think about it as a way of not putting all your eggs in one basket. Diversification helps smooth out the bumps on the road to long-term investment success. It's a risk management strategy that can help to limit losses, and generate consistent returns over time. So instead of betting everything on one company, Buffett's strategy encourages us to build a well-rounded portfolio that can weather the ups and downs of the market. But there's another element to Buffett's strategy that's equally important: patience. In a world where we're often encouraged to seek instant gratification, the idea of waiting for returns on an investment might seem archaic, but patience is a virtue that can pay off handsomely in investing. Buffett himself once said, "The stock market is a device for transferring money from the impatient to the patient." This quote encapsulates the essence of his investment philosophy. It's a reminder that the stock market isn't a get-rich-quick scheme. Instead, it's a platform that rewards those who are willing to invest in quality companies and wait for their intrinsic value to be recognized by the market. It's not about timing the market, but time in the market that counts. So while it might be tempting to pour all your money into a company that looks like a sure bet, remember the importance of diversification. And when the market takes a dip and it seems like everyone is selling, remember the value of patience. Successful investing requires a long-term perspective and the discipline to stay the course, even during periods of volatility. Buffett's wisdom isn't just for him to keep, he shares it with us too. And that's where we can tap into some of the most valuable lessons in investing. If you're looking to learn from the best, you can't go wrong with Warren Buffett's annual shareholder letters. These letters, penned by Buffett himself, are a treasure trove of insights. They offer a glimpse into the investment giant's mind, his philosophy, his strategies, and his reflections on the past year's investment decisions. Each letter is a masterclass in investing, presented in Buffett's characteristic, clear and engaging style. They're not just for Berkshire Hathaway shareholders, but for anyone who wishes to understand the art of investing. But the learning doesn't stop there. For those who can make the trip, the annual Berkshire Hathaway meeting in Omaha, Nebraska, is a unique opportunity to hear from the Oracle himself. Often dubbed the Woodstock for capitalists, this gathering lets you soak in the wisdom of Buffett and his longtime business partner, Charlie Munger. Their candid discussions, insightful Q&As, and reflections on the state of the market offer invaluable lessons for both beginners and seasoned investors. So, how do we take all this wisdom and apply it to our own investing journey? The answer lies in following Buffett's principles: understanding and practicing value investing, conducting thorough research, diversifying your portfolio, and exercising patience. It's not about chasing after the hottest stocks or trying to time the market. It's about discipline, a long-term perspective, and a commitment to learning and growing. Investing like Warren Buffett isn't about chasing hot stocks or trying to time the market. It's about following timeless principles, conducting thorough research, diversifying your portfolio, exercising patience, and continuously learning from the best. And with these principles guiding your journey, you too can strive for success in the world of investing. So, are you ready to start investing like Warren Buffett? The principles we've covered today, value investing, thorough research, diversification, patience, and continuous learning, are your roadmap to emulate the Oracle of Omaha. It's not about quick wins or hot stocks, but a journey of consistent, informed decisions. And remember, wealth building through investing is a journey, and by applying Buffett's principles, you too can strive for financial success.